Hello fellow traders. I'd like to give you my take on why 90% of day traders lose money. The majority of day traders fail for one simple reason. They trade without a plan. Many approach the markets emotionally and chasing quick profits, scalp trading, reacting impulsively to price swings, and abandoning the discipline after a few losses. And also, may I also add, not having taken a trading course or learning how to trade through just trial and error. That works too for many people, some people. They understand that trading is a probability game. Good traders, that is. It's not a guessing game. Each trade is just one event in a series of many where consistency and risk control matter more than being right. Now with Timeless Dollar Trading Academy, I emphasize that profits follow process and not prediction. Although the Taylor Trading Zone is a good predictor of where prices are likely to trade. I also want to talk about the psychology of winning trades. Fear and greed are the twin forces that drive markets and destroy traders. Fear makes you hesitate to enter or exit when you should, and greed pushes you to overtrade or hold too long. Now, winning traders conquer both emotions by using structured setups and predefined risk parameters. Now, this is different for everyone. When you know in advance where to enter, where to exit, and how much you're risking, emotion is less a part of how you trade, and emotion doesn't guide your trading. Mastering psychology isn't about eliminating emotion, because you really can't. It's about channeling it into disciplined execution. How about stop loss strategies? Traders who refuse to use stops are gambling, not trading, but not all stop losses are created equal. Now, I want to just tell you at this point, I use stop losses, but I don't place them as hard stops. I have mental stop losses, and that's because the market sees where these stops are. And that's why you see stop runs that take out the stop orders, the buy and sell stop orders. And so I don't want the market to see where I place my stop. I have a stop. It's a mental stop. When prices hit that point, boom, I'm out. And so that's my stop loss rule. But you need stops to protect your capital in case the market moves against you. In Taylor-based trading, for example, stops are often placed outside the forecast trading zone. But that's a very wide range. It could be anywhere from 30 to 120 points. On an average day, it's around 60, 70 points. So you're really not going to place your stop 60 or 70 points above or below where the market is going. So you place your stop based on what you feel is right for you and the size of your account. But I generally go for 10 points being the minimum stop loss that you can consider because the markets trade so erratically, certainly the S&P E-mini markets. So really, you want to build a trading plan that you can stick to. A trading plan is your personal roadmap to consistency that defines your setups, entry rules, exit rules, risk limits, and daily routine. Without it, every trade becomes an emotional decision. A proper plan should also define when not to trade, and for me, that's most days. When prices open outside the Taylor Trading Zone, or when volatility is extreme, or when prices open in the middle of the trading zone, these are days where there's, to me, a lot of risk, and I don't want to take that risk. Now I'm going to talk about a word that I mention in every one of my videos, and that word is patience. Patience is the trait that separates good traders from amateurs, professionals from people who lose money. Traders don't fail because they misread the market, because they trade too often. Great setups appear only a few times a week, and the rest of the time, the market is volatile, it's a noise. Learn to wait for a valid signal, such as a confirmed momentum shift, one of the 6 trade setups, a candlestick pattern, and trade especially inside the trading zone. Patience isn't inactivity, it's preparation and it's experience. You've got to learn to watch the market. And when the market aligns with your plan and what you know about trading and your experience, you're going to be a much better and consistent trader, and you're going to make money more consistently. So let's go through the trading week to see about analyzing the trades based on the 6 trade setups, the tailored trading zone, and other things that we might observe, of course, the previous day's close, which I always represent as a horizontal line on my chart. Okay, in the previous day's close is the black horizontal line, the trading zone is the rectangle. And so I've drawn my rectangle beginning at 9:30 to 4 p.m. Eastern Time, and this is the S&P E-mini. Trading zone works for most futures markets, and so I'm going to take you through it beginning just prior to 9:30. And Friday, October 10th, was a day where President Trump announced a 100% tariff on China. I'm going to stop it right over here. 100% tariff on China. Now, normally the trading zone is pretty accurate in terms of telling us where prices are likely to trade in terms of the range. But of course, when the president's saying that we're going to slap 100% tariff on top of the 30% tariff on the country from which we import most of our products, well, that of course send the market into an immediate tailspin in a momentum trade. And of course, the momentum trades, for the most part, they can't be anticipated because they happen like this. They happen too quickly. However, as part of a time and price trade, the momentum trade, the first leg of the time and price trade with a momentum action, is a very good setup. And the setup is the first leg being prices moving in a certain direction for a certain amount of time, and then stabilizing for anywhere up to an hour, and then moving in the same direction for the same amount of time. And I'm going to continue the video and show you exactly what I mean. Okay? And here's how the trade worked out. And the trade was the second leg from the equilibrium down to the second leg. And there are 20 points between each horizontal line on this chart. So we have 20, 40, 60 points, actually closer to 70 points if we take it from the middle of the equilibrium. So 70 points in a trade that took a little more than 15 minutes, okay? 70 points. And nobody's going to be unhappy with that. And so this is the time and price trade, one of the 6 trade setups. I have it right here, time and price trade. Particularly brutal day for the market, and the market needs time to recover on days like this. Market just does. When you see a day where prices move in a range that is so atypical for the market, sit it out, wait till the market stabilizes. Let's go over to Monday, October 13th. The forecast range, when I factored in the numbers from Friday, the range went off the chart, 157 points. And of course, prices didn't trade anywhere near that because they need to stabilize. Market needs a day or two to stabilize. So let's go over to Tuesday, October 14th, and the range forecast starts to get a little more normal. And Tuesday, October 14th, was a day that I love because the setup is absolutely phenomenal. Prices trade beginning at the bottom of the trading zone, fade the trading zone, that is, move away from the trading zone, and then reverse and trade all the way through the trading zone. And the trading zone range for Tuesday, October 14th was 76 points. You could have easily made the 76 points. When the market begins at or below the trading zone support, or at or above the trading zone resistance, and fades it, particularly good day. And I'm going to prove my point a little further on in the week. So possibly 76 points, a much more well-anticipated trade. And notice that the previous day's close, also prices closed the gap. Terrific day for trading on Tuesday. Let's go to Wednesday. The range forecast was 130 points. And remember, I said when prices trade either at or below the trading zone support, or at or above the trading zone resistance, these are terrific days. And when prices do this and fade the trading zone, as they did on Wednesday, October 15th, prices opened above the trading zone, faded the trading zone, in other words, moved away from it, and then moved down into the trading zone. And this is a day where we can clone it. Remember, the range forecast was 130 points. When market stabilizes, the Taylor trading zone is particularly accurate in terms of the range that's forecast. So if I clone my range and I transpose it to the intraday high in the first half hour to hour, okay, this is where the market puts in its high, starts going into the forecast trading zone. I could clone it and I get my approximation of where the market is going to bottom out. And it did just about, let's see, 650 and the bottom was 630, about 12 points from the forecast bottom of 130 points. All right, so about 118 points is where the market actually ranged, all right, 118 points. A very good day again. I want to point this out again. I'm going to go back to Tuesday. Prices opened above the trading zone, faded into it. Prices opened below the trading zone, faded, then went into it. Perfect day, perfect setups. These are ideal setups. If you wait, if you trade like this, if you wait for these trade setups, they don't happen all that often. Here they happen twice in 1 week. Fantastic trading setup. Now here on Thursday, October 16th, market opened just above in the middle of the trading zone. They did close the gap, traded back basically through the trading zone. Again, the trading zone, the range was 107 points. The market actually traded within that range. I'm going to clone it to the intraday high. It was put in right about over here where the market go down to. Here was the other end of the day's candle. Perfect setup, but not ideal because when prices trade or open in the middle of the trading zone, they can go up, they can go down. We don't have all that room to trade into the trading zone, either down through it or up through it. All right, but still pretty good day to trade. Friday, October 17th. Again, prices traded right at the previous day's close. Basically went nowhere throughout the day and closed out the week that way. So excellent trade setups. Again, don't trade every day. Friday, October 17th, not a great day to trade because there's no indication. The prices traded at the previous day's close. There's no gap trade. And prices basically traded within the support. We can see the support put in. Okay, support put in right over here at 66.42, and that happened on Monday as well. Let me go back to Monday. Here, Monday, prices traded right at a support and resistance trade. If you want to wait and watch where prices bottomed out, reversed right about 66.62, and so Monday you could have used the support and resistance trade as well. But Tuesday and Wednesday were fantastic trades for big trade setups, big range, big points. That's my video for today. Patience, again, as I said, is the key to trading. Most days you should sit it out if you're not sure. If you want to know how to be sure or how to be less unsure, take my course at timelessdollar.com. Of course, I urge everyone, look at the Taylor calculator at timelessdollar.com. It's a fantastic trading tool, and it'll guide you to make very good trades with big profit potential. So that's what my recommendation is. Thanks so much for watching. Trade safely, use lots of patience, and I'll see you in my next video. Marv Eisen for Timeless Dollar Trading Academy.